along, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Sunil Subramaniam, MD and CEO at Sundaram Mutual Fund, joining in. Welcome to the show, Sunil, and always a pleasure to speak to you and get insights from you. Sunil, overall, if you go to see now from what's happening in the markets, you have FIIs which have started to take some position and the action is coming back. What's your read of the situation?
See, our read is that it's an extreme sweet spot for India. Say that is that I know that since 1st of July, FIs have come back, markets have again retraced all their losses and come back on highs. But if you look at the data, right, and look at the logic behind an FII return, right, you will clearly see that when in 2019 and 20, when oil prices were declining worldwide in the COVID phase, that's when India got money. So there's a strong correlation between the expected trend of oil prices and commodity prices with India because we import 85% of our oil. So the oil prices not only impact our fiscal deficit and trade deficit, they not only impact stock market margins, they also impact FII's outlook on India because of the currency, tending to weaken. So whenever oil declines, India is a very, very attractive market. And when oil rises, it's a very opposite. So what happened between October of last year and June of this year was that oil went up to 125. People are expecting to go further to 150, and that led to kind of panic reaction from hedge funds, and about 2.5 lakh crores of money went out of Indian markets. But part of it went back to the US because interest rates were rising in the US. So the debt market was a good investment, but a lot of it went to commodity exporting markets which were expected to benefit from oil. Now, of that 2.5 lakh crore, about 60,000 odd crores is what has come back. So to me, there's still another 2 lakh crore of money which can relocate to India. And at the same time, declining oil will mean that all those companies which are using oil-related derivatives in their products, like auto company, like a paint company, like a tire company, like a fertilizer company, all of them will now get a big break on their costs. And whether they pass on to the consumer, to increase sales or keep it in their profitability to improve margins, either way, that's good news from a corporate India. And for India, the fiscal deficit pressure from a trade deficit of oil coming down is unimaginable. So I think this situation, while it's bad news for the world and recession and interest rates hike, I think India is a shining star in this whole space. And I think that compared to last October, when FIS went out, Indian investors in post-COVID were selling. But today, Indian investors through a strong 12,000 crore SIP book are actually buying. So you have a double engine support to the market liquidity, that there's FPI liquidity and there's domestic liquidity, both acting as a support to the market, which I think will mean that in the coming quarters, with the last quarter's results did not show all the impact of the commodity price drop, because halfway through the quarter is when it started dropping. So in the coming quarters, you'll see the margin impact on EPS also, and hence market will also revise their expectations of EPS. So all in all, I think we are in a very, very, I would say, extremely bullish kind of a thought process on India, because CapEx drive of the government, of PLI and private sector is also something which is not very linked to international recession.
Right. So that's an interesting point, Sunil, that you've made as well. And specifically, coming to the India growth story, then are we saying that the recessionary talks that we're looking at from a Europe and US perspective, India is highly insulated and we become one of the best spots amongst emerging markets or even developed?
The second half of your question, I would agree, in terms of we are one of the best spots in the emerging space. But to say highly insulated is a little bit too much. Definitely, Indian exports, if they have to grow, the world has to grow. So definitely a recession would have an impact on Indian exports, and export-oriented sectors like IT, pharma might face that the kind of growth projections they had in the past, they will have to revise it downward. So I would not say highly because a global recession will impact Indian growth story through exports to some extent. Let's not get carried away by that. But fact is that India is still a very domestic, resilient economy. And the second is that there is this world shifting from a bipolar to a multipolar world. That is, the world is heavily dependent on China for manufacturing most of its goods. And I think that feeling, which is now there's a, what I would say, not a negative feeling, but people do want to de-risk themselves away from China because of the fact that, COVID is again kind of showing its head. Chinese costs have gone up for labor costs. China's population, working age population is declining. So an alternative to China, India is in a pole position to exploit it. But the true benefit of that exploitation will happen when the world comes back after the recession. So I would hold my horses to say that, we are completely recession proof, but at the same time, we are not going to get hurt by the recession by any means, anywhere close to what the advanced economies are going to get hurt.
Right. So taking this point into consideration, would it be right to say, Sunil, that it's best to be invested in domestic oriented sectors versus export oriented sectors to start off with till things start improving globally?
Agreed with you. My only qualification there would be that an export sector like IT, while its growth may get dampened a bit, will still remain in your portfolio as a safety pick. Because in a recession also, what tends to happen, Hiral, is that IT cost, infrastructure costs are a big piece for a lots of user companies, and they would like to reduce IT costs. So actually, IT business could improve because people are trying to reduce their IT costs, compared to, say, doing it in the US versus doing it in India, right? So I would say that I would not ignore IT from my portfolio, right? Because I think that IT as a safety component is a critical part of every portfolio. So I would not say, when you say export negative, I don't say that I will be underweight the benchmark weight, but I can't ignore it. I think it's a very strong sector for India. There's a strong employment generator, strong foreign currency generator, and I think that even in a recession, it will hold up.
Right. So that's with regards to, when we talk about domestic as well as export oriented sectors. So what should one's strategy be, Sunil, from here on to look at investments? Because when the markets were on a downtick, everyone was wondering, is this the right time to invest or should we wait? Now that it started to move up, people are of the opinion, are we going to miss the bus from here on, or we should still wait? What is the so what would your advice be?
See, a few months back on your show, I was saying it's the right time to invest, right?
Correct.
You collect that. So today, that's why I started my conversation by saying that this recent rise in the markets is on the back of just 50,000-60,000 crores of FI flows coming. I said there's another 2 lakh crores, which is 4x of this money waiting to come back. And you're already seeing oil now breaching below 90. You already reached the pre-Russia-Ukraine war level of oil, right? And any recession is going to mean further decline. So India's attractiveness in a declining oil price scenario only increases. So I would say that don't worry about the fact that the market has run up on the back of this 50,000 crores. It's a long journey, and I'm sure that the Nifty will touch new highs in the coming years. And there's no reason for you to think about any other market for wealth creation than the domestic equity markets. I think this is the time to invest. Yes, there will be short-term volatility as the Fed throws out some news, some data point comes out in the US, RBI will hike rates to control the currency. News flows will always come and drive volatility in the market. But for the long term, remember, every correction represents a wonderful opportunity to buy. So buying on dips is, of course, there. But for a retail investor, I think this is a very good time to keep a steady allocation into equities, because in the next 3 to 5 years, right, I expect the market to deliver strong double-digit returns.
Right. So overall, if we have to, talk from this perspective and from a new investor perspective as well, Sundaram recently launched the Flexicap NFO as well. How would you differentiate that to the other funds that are available right now? And what is it that it'll help? Because again, it'll reopen, right?
Yeah, so it's reopening on Monday, and thank you for bringing that up. I'd like to take this opportunity to thank all our investors, more than 70,000 investors who have exceeded our expectations by giving us about 1,679 crores as the NFO collection.
Wow.
It's the second highest in our 25-year history. So that's something that we are eternally grateful for, and our attempt will be to try and meet their expectations and exceed those in terms of the performance. The advantage that a Flexicap NFO with the fresh money is that the allocation can be right positioned without any past over allocation to be reduced, past under allocation to be increased. You need to sell in an existing fund, you need to sell something to be able to buy something else, right? And that's $1 million question. Whereas for us, with the fresh pool of money, with the outlook being so clear in terms of domestic economic growth, oil price trend, international recession, FII flows, I think putting the right large cap, mid cap, small cap mix, putting the right sectoral mix from day one will give this fund a head start in terms of no need to backtrack on any of our past decisions, but take fresh, clear-cut, long-term decisions for the fund. So that would be its USP. Second is that we have over a 25-year history built up a strong, research-based approach to mid and small caps. And Sundaram has been known for that space. So we expect that the mid and small cap component of the Flexicap will be the alpha generation engine, right? Whereas the large caps will be the compounding, growing along with the nominal GDP of the country kind of a portfolio. So I think that USP of mid and small cap based on research is where we will, create a outperformance, hope in this fund.
Right. So to that, as you mentioned, the strategy is going to be large cap, mid cap, and small cap with positioning respectively. But any particular sector focus that we're looking at? And secondly, what would be the best time horizon to stay invested?
So I would say, let me reverse it. I would say 3 to 5 years should be the time horizon, because our allocation will be to essentially three big sectors. That's one would be the investment sector, which is capital goods, building materials, cement, steel, EPC contractors. So all those who are going to benefit from the capex revival in the Indian economy, which is driven on three strong pillars, which is government-driven capex, both central and state, PLI-driven capex, where the China Plus opportunity is being played out, and about 2.4 lakh crore of investments to happen. The government also spending about 100 lakh crore over in the national infrastructure pipeline. And private sector capex has rebounded in a big way because capacity utilization in the country has already crossed our long-term average. It's back at about 76%. And so private sector has started reinvesting. So to that extent, the investment side of the economy is going to be the key growth driver, and our portfolio will reflect that in a big way. The second is the revival in consumer discretionary, because consumer discretionary suffered because of 2 years of COVID, suffered because of the fact that commodity prices, which are a key input cost into the manufacturer, right, went up, and so their margins got shrunk. So we expect from this Diwali, with the next leg coming during summer, consumer discretionary revival, and driven by the fact that a good monsoon has meant that rural India is sitting on cash. And so we expect a double-digit rural demand growth to come and fuel the discretionary consumption boom, where I include auto and housing also as part of discretionary consumption. That's the second pillar. And the third overarching pillar, whether it's the investment cycle or the consumer discretionary cycle, both of them are dependent on bank funding for growth. You can't build capex without having significant bank finance. You don't buy a refrigerator or a car without taking loan from a bank. So the banks have sitting on flush on money. They have had a COVID period where they over-provided for NPA, and they're all now seeing declining NPA. They're well capitalized, and any interest rate hike is passed on to the whole lending book. But any interest rate hike is only passed on to incremental deposit book. So the bank interest margins, right, NIM, net interest margin, are expected to widen. So to me, the banking and financial services sector is a very strong, solid pick. So these three would be the key sectoral pillars of our fund.
Right. And overall, Sunil, if you could just let me understand, banking, interestingly that you mentioned, there is a lot of interest that's coming in from the banking, for the banking and financial space. And last 2 to 3 years, we've actually seen banking space actually emerge out of the woods, because otherwise, every time we've just been talking about the asset quality issues, the provisioning issues, etc., etc. Do you think this is going to be a long-term growth story from here on for the banking space as well?
Absolutely, because I think banking is the blood circulation of the economy. Banking essentially, the Jan Dhan Yojana program of the government, I think, gave a big fillip to the formalization of people's savings away from the money lending, chit funds, and unorganized sector into the banking sector. That's one big change which happened over the last few years. The second is that overall banks have by and large shifted their lending book to a floating rate book. So fixed rate loans are there in the 3-year auto loans and some personal loans. Otherwise, working capital loans, term loans, housing loans, everything has moved into a floating rate kind of. So in a rising interest rate scenario, that's a sweet spot for banks. The third is the fact that as per capita income, you see India just crossed $2,000 a few years ago. Whenever a country crosses $2,000 over the next decade, we have seen that it explodes. China went to $10,000, Korea went to $28,000, Malaysia went to $12,000. So India, even if we, let's say 2,000 goes to 4,500 or something like that, you will see that the people's income, when they go up, their savings ratio goes up, because you can't keep spending all that you earn. So that savings naturally comes to the banking system. So the banking system is going to be flush with people's money to deploy. So I think that in India, with the mergers and acquisitions, with the government planning to merge PSU banks and privatize some of them, their ability to then become global scale, like the HDFC HDFC Bank merger is creating this global scale. So when you're able to raise international resources, right, as a global sized bank, you see what happened with Japanese banks or with Chinese banks when they really went abroad for raising money. I think that banking is the true super growth story for India over a period of the next decade, I would say, in terms of a play, because we are in that cusp of that revolution.
Absolutely, and that's what it seems like from the way the quarterly earnings come in. And Sunil, what would your view be with regards to where real estate as a sector goes? Because as you mentioned, on the investment front as well, from cement to other companies, other sectors, a lot of it comes in from the real estate space where these sectors have dependency on. And post COVID, we've seen that the demand has gone up, sales are shooting up. So do you think that's a good space to be in as well?
Absolutely. See, I'll tell you why. Because I think that it's what was the most unorganized space in India. It was the most, what I would say, number two money, if I may use the word, right, where it was deployed. So this whole process, starting from demonetization to GST, the government regulatorily has been entering into this sector to clean it up and give it a nice thing. So the Aadhaar housing project, Housing for All by 2024, the RERA introduction, right, the clearing up and making that sector kosher. That's number one. So the government is strongly oriented towards the real estate sector for the simple reason that employment generation is the biggest need of the hour, right? In a 10-year period, we are adding almost 12 crore people into our working age. So employment generation, because real estate is the largest employment generator, the government is positioning it to support it so that the burden of generating employment is not on the government, but by giving a boost to this sector, employment generation will happen. So that's strong policy support. The third aspect is that, as I said today, is that in a lowish interest rate scenario, people are looking at real estate not just as a shelter roof over my head, but as a source of income for my future. Because it is inflation protect, because rents do tend to go up with inflation. So what has happened today is that if you look at a housing loan today, I know they are no longer at 6.5%, maybe they're at 7.5%, but you take a post-tax, there are up to 2 lakh interest, capital, you get ATC benefit. If you take the post-tax cost of an EMI to buy a second house or a third house, and you look at the rental yields are also rising, the gap between the post-tax cost of a second house from an EMI perspective and the rental yield is narrowed down to 2 to 3% today. So with just 2 to 3% of my income allocating into real estate as an investment vehicle, I'm able to acquire an inflation protecting long-term asset. So that's the reason for the demand. And COVID also made the very critical necessity to have a second home. And people sitting in cramped quarters in the metros are looking at just the suburbs to get into a 3-bedroom or a 3-bedroom plus study. And so that's also fueling the demand. So in that context, for me, I think real estate is in a sweet spot. And still in the capital market, the number of listed real estate companies is very small. So if you have to play the real estate game, there's only a few set of scripts which are there. So years ago, if you remember, Maruti Suzuki got a lot of benefit because there were no other listed auto companies in the Indian capital market. So if you wanted to play Indian auto, you had to play Maruti. That was the history, right? Similarly, in the real estate, what will happen is because there is very limited supply of real estate related stocks in the capital market, they will tend to play the whole real estate story through those few stocks. So there is that tendency then for, so you have to look at it carefully because some will get overvalued because of all this expectation, right? But the beauty of it is that ultimately real estate not only generates employment, but gives business to 10 to 12 other industries. So you take cement, you get steel, you take wood, you take paints, you get tiles, you get interior decoration, you get, PVC pipes, you get electric wiring. So it's a multiplier effect for the economy also. So no wonder the government is also fully supporting it. So I think real estate makes good sense to be, kind of a little bit overweight on real estate as a part of your allocation.
And very lastly, Sunil, then what are the sectors that you would say you should either have the least allocation or avoid?
So I would say that, to me, energy and utilities, because you are in a declining energy price scenario, right? So I would say that they are not well positioned at this point of time. Similarly, pure commodity oriented plays are also going to be seen in a kind of a slightly pressure in terms of the prices there. The third is an export oriented. I already spoke about IT. I said there's a core safety demand for IT. So while it won't be a growth sector, it's definitely a safety sector. But other other export oriented sectors, right, in a recessionary scenario may go through a period of a crisis. Because remember one thing, export oriented sector also tends to benefit from rupee depreciation. But in a scenario where if the US and Europe go into recession, you're likely to see interest rate cuts from today's interest rates hikes, and that's negative for their currency. So rupee is weakening. Already rupee is not weakening as much as rest of the world's currencies are. India are doing much better than the British pound and the euro against the dollar. So weakening. So this is relatively, actually, rupee is strengthening itself in the world market except against the dollar. So from an export perspective, that's not a tailwind which is going to be strongly supportive. So export oriented sectors, I would be cautious, barring IT, which should be a safety component. So these are where I would be underweight today. And finally, FMCG. Now, FMCG suffered a bit because of the global food prices increasing, right? Now that with the commodity price easing, they will get that support on their margins. But, FMCG is again a safe, stable Hindu rate of growth kind of sector, right? So it's not going to be your growth sector. It's not going to be your multi-baggers. So I would say that, again, like IT, FMCG should be there as a safety component, but not necessarily as the alpha driver.
Absolutely. And these are important points that one needs to watch out for as well. But thank you, Sunil, so much for joining us on the show. Lots to take from a conversation that we have with you. Gives a clear direction to the investors and the viewers as well. Thank you. Stay safe and speak to you soon again.
Same for all your investors. Wishing them all the very best. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.